Welcome to Salty Investors episode. I don't even know. It's been that many. I think it might
9.
be 9. Is it, Tim? Yeah. So how are you doing this week?
Better than I deserve.
Better than you deserve. Well, I bet you it's not better than I deserve. So let's kick off as usual with the salt for this week. What do you got for us?
Basically, I invested a little loan business that loans paid our loan business and put a couple of $1,000 in and just see how it goes, and then signed up digitally and tried to withdraw my money, and they get me to sign up for a whole heap of forms,
Yeah.
to manually put it in.
Yep.
The old thing about the exits, you can sign up quite quickly, but the old exits are very crowded when you go to exit out of these things. So
Yeah. It's always the way, isn't it? Easy to get in, much harder to get out. It's like a digital subscription to a newspaper. You ever tried to end your subscription? You've got to. I mean, you need to be like a detective to find out where you actually have to unsubscribe. If you like, this is true. If you want to unsubscribe from a subscription from the Australian or the Sun, a Murdoch paper, you have to call up. There's no way to do it. You can't do it online. You have to call them. And of course, I kept doing this. They say to you, "Oh, would you like to extend? We'll give you 50% off." So you keep just extending it and getting these, and
yeah,
it's very hard. So, did you get your money in the end?
Well, the redemption's in the mail, so you wait a week, hope the letter gets there, and then we'll see what happens.
But you had to send snail mail. Is that what you're saying?
Yeah. Get a stamp out and all that, sign a letter. But the thing is, to sign up, it's all digital. It's just like,
yeah, of course, yeah.
To get the money back out. I'm just worried there's a recession coming, so I'm thinking, risk adjusted. Probably shouldn't be mucking around with personal loans that are unsecured.
Yeah.
I thought, hold on to that. Like, bonds are doing pretty good at the moment, so government bonds. So why take that extra, couple of percent risk, for no security? So
absolutely no need to do that.
What are you salty about this week?
Well, it's kind of related to last week. If you remember, last week I was salty at the idiocy of people asking for or demanding super profits taxes for resource companies because they're making out like bandits. So this week that's continued. But what's happened is a couple of politicians, namely Adam Band, has put up a graphic showing all the revenue that these large companies like Chevron and all these others have generated, and said, where are the taxes on these? They haven't paid any tax. And of course, you don't get taxed on revenue. I mean, this is just a rant about financial literacy. This is the head of the third largest party in Australia saying this, and he's financially illiterate. And the amount of people that then retweeted that and said the same thing is just ridiculous. And of course, even I think Chevron's actually said that next year in this country they're going to pay an enormous amount of tax, actually, because all of that spend has happened. And just the general illiteracy of, look, one of the reasons is because they spend a heap of money on capex, and then they get depreciate that away. Huge amount, hundreds of millions of dollars in expenses. Of course that happens, and then they reap the benefits of an upcycle, which they've been doing. But it's just a rant about financial illiteracy, and how many people believe it. It's just
income tax isn't included in that as well. Like, show me an oil worker that's working for $35,000 a year, and paying zero tax. So much of that ends up in the government's pocket. So I don't know, just normal politics, I suppose.
Yeah, a lot of politics of resentment in there, that's for sure. And I think that's just because that's the climate, because people are feeling the pinch. Stuff's gone up, costs of everything's gone up, and of course the easy thing is to point at the people who make a lot of money and ask for more donations. Anyway, that's enough salt. So I just this was from John Hussman's letter. He puts one out a month. So this one's it's a few weeks old, this one anyway. But basically what he's saying there is that then we're not even close to a pivot, basically. If you use this as a guide, which is to say that the Fed funds rate usually has to get above core PCE, which is their preferred measure, right? And we're not even close. So it's sort of, I just wanted to throw that out there. You know, people get excited about a pivot. And then the next chart following on with that is that, look, it doesn't, just because they do pivot doesn't necessarily mean markets go up, right? This is what this chart is showing. Now, he's got sort of 4 lines there. Monetary easing, internals favorable. Now, his internals, it's a proprietary measurement that he has, but, you know, it's just somebody, it's the market's propensity to speculate in a broad-based fashion. So, it might be just the strength of trading volumes, how many stocks are trading over options, their 200-day moving average, options. Yeah, so whatever it is, that's all it is, really. And so you can see there that actually the worst performing measurement here is when there's monetary easing and those internals are unfavorable. And that was exactly what you had in 2008, in 2001 too. Markets just kept going down while the Fed cut interest rates. Maybe this time is different. I mean, this time is bound to be different, but it's just not a given that when the Fed turns around. And remember, this is a pivot, which means they actually start to cut rates, right? When I think, again, as we've said all along, you might get to, say, let's say the Fed gets to 4.5 or 4.75 or 5 and stops. It doesn't necessarily mean they're going to go straight down, start cutting immediately. They might just sit there for a while. I mean, look where the RBA is right now, 2.85% with inflation. They say is going to hit 8% before the end of the year. So it's not immediately apparent to me that they start cuts once they stop rising. You know, they could just sit at, like, if the RBA goes another 25 basis points and they're at 3.1, they might just sit on 3.1 for 3 months or 6 months. Who knows? Yeah. So again, I think the conditioning of the market that pivot means risk on, this might be mistaken. But the problem for people like me is that I might get left behind. You know, that's always the
when the Fed pivots, there's a reason for it to pivot. You know, obviously something's gone bad, seriously gone bad. Like, it's not just, they don't just pivot because of the fun of it. You know, like they're trying to save things. So just who wins in that situation? How bad is it compared to how much? But the Fed's hiked a fair bit already. They have got a fair bit of room now. So that's what everyone. That's the current theme at the moment, anyway. You know. But this is showing something different. So he always hurts me hard. This Hussman, like when I read his stuff, it just, it's very, very hard to invest after reading his stuff.
I mean, he's very empirical. I mean, people have lambasted him as being sort of a perma bear, but I mean, in October of 2008, he came out and said, "Look, it's time to buy," because valuations had gotten, really low. They didn't stay there very long though, but so he sort of turned cautious again. But I mean, his work's empirical and there's not much to argue with. People just sort of keep yelling, "You're a bear," as though that's an argument. It's not really. He does make it tough for you to invest. That's for sure.
To speculate.
I just thought this was interesting because actually you and I had talked offline. I'd been looking at James Hardie as maybe something I could get interested in. About a month ago, I think I was talking to this offline. So they in their previous quarter came out and said, here's our guidance and things look good. Now, third quarter comes, and over the past 45 days, we've seen a significant change in the outlook of the housing market activity for the second half of our fiscal year. And in most of the geographies we participate, in North America, single-family new construction starts have slowed significantly, and market expectations for the remainder of our fiscal year have declined sharply. So the outlook and guidance there was basically they cut their guidance range for net income by about 10%. The stock fell over 2 days, fell about 15%. So I bring this up just to say, obviously interest rate rises have now flowed through to the building sector in the US because they're mostly exposed to the US. It's obviously here in Australia as well. And so I just thought that was an interesting sort of...
But 10% guidance down isn't a huge, like he says,
no,
decline sharply. Like, is 10% sharp? Like I would have thought.
Yeah, you can just, I don't know. I mean, because see now you're getting into this. When times are good and you're in a bull market, people's confidence about the future is usually, over exaggerated. And so they have confidence in forecasts that 2 years out, 3 years out.
Yeah.
And now what you're seeing is, of course, that the confidence in forecasts is shrinking. So now you see, for me, I look at this and go, okay, they've been conservative, they're downgraded, but how long does this one last?
Mm-hmm.
Another quarter? And then they're downgrading again? So that's why I think you see such an extreme reaction. The stock was down 14% in one day, and then it fell another percent the next day. Who knows? But yeah, I mean, I think that's the problem in this current environment. If you think you know what 2023 looks like, I think you're probably kidding yourself.
Yeah.
It's just very, very hard. I mean, Shane Oliver of AMP put out a note on Livewire Markets yesterday saying he thinks Australia will avoid a recession. And Shane Oliver's a pretty good contrary indicator, I think. He might be right. But this is the problem. It's just we've been talking about earnings and they need to come down. It's very hard to have confidence in earnings projections right now. And I think the way to go is down. That's the way they're going.
Mm-hmm.
I suppose you can accuse me of cherry picking here. But here's another couple of... Roku has said that, and you know what Roku is, don't you?
The streaming devices.
Yeah. So they say they're seeing a lot of big categories in their advertising pull back. The significance of that is that this is the time of year when the advertisers usually ramp up going into Christmas. So I just thought that was interesting. Cardlytics, never heard of it before, but I saw this. I got this from a couple of guys who do an earnings call podcast. They just sort of They just sort of sift through comments from CEOs and CFOs on earnings calls and just pull out sort of what's important. So these guys this stock is down over 90%. So it's basically a sort of digital marketing company. And they've just, the analysts thought that they were growing, they were going to grow over 10%. They actually declined 6%. The stock fell 53%. See, this is what gives me pause. Is something you just said before, which is that, like, it seems that there's overreaction now, to these, if you disappoint, you're going to get absolutely smashed. I just thought that was interesting. Advertising, obviously, that's a sort of bit of a bellwether. I did see a company, another advertising company who said that their revenue was up 30%, called Trade Desk. Their revenue was up 30%, from the year before. So, and they're sort of like Cardlytics, if you like. They do the same sort of thing. So, yeah.
So why aren't CEOs front running this a little bit and actually putting out guidance that's, that they're going to beat, sort of be conservative,
Yeah,
why are they still holding off you know, I guess they're just worried about the short-term price. You know, if they're getting hammered this much, they don't want to say, oh, you know, we're going to be down 20%, you know, what the whole thing's going to get wiped off the books or something. Like, but if they keep, you know, they keep missing expectations, it's just going to keep going down. Like, surely that's not good for long-term holders.
Yeah. And it's just gives investors just lose confidence. Like I can't, you know, if I can't be confident, the only thing I can be confident in is, I don't know, Costco and Procter and Gamble, you know, and that, you know, everybody. But those stocks, the funny thing is that those stocks are already sort of, the people who wanted to, you know, sort of hide out in there have.
Yes.
Those stocks aren't cheap either, relatively.
Wow. Look at Costco. It's insane. So,
yeah.
I think even Munger said he'd sell now if he didn't love it so much, you know? Like,
right.
So that gives you an idea of like how overpriced it is. So, but I just, you know, I think CEOs need to grow some balls here, you know, like, like they're supposed to be running the company here. Like, they're not supposed to be, you know, trying to keep up the short-term, you know, share price.
Yeah,
they're
that's
supposed
right.
to be looking out not just 2 quarters, they're supposed to be looking out 3 to 5 years. But I think all the stock compensation, you know, all the stock compensation comes into it, and there's conflict of interest.
That's what I was about. Yeah, that's exactly what I was about to say. That not only their stock compensation, but if you think about tech companies, that's how a lot of people are remunerated now when they sign up. You know, they, you know, you will sign you on for 200 grand, and you know, like 60% of your comp is in shares. Which, by the way, does not do much for shareholders, does it? I mean, you're constantly issuing capital, diluting shareholders. Anyway, maybe this bear market will reverse that trend a bit. You know, people want to get paid in cash. Moving on. So I thought I'd throw this in. So I think it was about 4 weeks ago, I bought up Pointerra. And you said, why don't I buy it? And I did. And I went out and bought it. I bought it in anticipation of the third quarter, or their first fiscal quarter of 23 reporting. So I bought some in anticipation that would be good. Now, they did have record, as you can see there, they had record cash receipts of 3.4 million. They were actually operating cash flow positive by 200,000. But their ACV, which is annualized contracted value. Now, this is one of those made up terms. Now, I want to know why don't you just come out and say what your sales are, you know? Because this, you know, annualized contract value. Right, so their annualized contract value went up by 1.8 million. It's now through 20 million. But you see the glaring sort of difference between cash receipts and So, and they keep saying that gap between those two will close over time. It's not really though. So
it did early 2020. You can see here it was quite close, but
well, that's before. So. That's interesting, because if you know what your annualized contract value is, you know what your sales were for the quarter. Just tell us what your sales were, you know. And the other thing I don't like is when companies start spruiking the following, like see down the bottom there, during the quarter, Pointerra teamed up with a tier 1 US defense contractor on a multi-year contract value at circa $1 billion, right? Now, if you know anything about US defense contracts, no one issues you $1 billion contract. You get a little taste, you know, and that you know, here's some money, do this, okay, and it takes a long time. Plus, they're teamed up with somebody else, so who knows what not their direct. Actual. You know, it's not direct. It's not like, oh yes, we want $1 billion contract, even if they get the. I just don't like that kind of spruiking. You don't, you know. It just, I don't know. I don't like it. I don't like when people start talking.
The midterms are on. Looks like the GOP is, you know, going to maybe hold both houses, and there's talk of defense spending maybe, you know, not going up as much as what the Democrats were doing. So I don't know. Might be headwinds.
Yeah. Yeah, I mean, I see those kinds of things. I think it's best ignored. Where's the runs on the board? So I just thought I'd bring this up because I sold it. I just sold it on the back of this. The it was a little bit underwhelming that how they've been growing recently. They only added another, if you use their metric, 1.9 million in annualized contract value, which was only 10% increase over the previous, and they've been increasing at higher rates than that. And yeah, I just don't like the feel of that. What the CEO is saying, that this gap between their annualized contract value, whatever the hell that is, and however they figure that out, and their cash receipts, I just don't like it. And by the way, the broker that covers them cut their forecast for bottom line profit this year by about 20% already. And they cited this because of the timing of cash receipts and so there's something there that I just don't like. And I think actually when they get their second quarter in, that broker will be doing the same thing. They'll be probably cutting their forecasts again.
Well, you might be able to buy back in then, at lower
well, this
price.
is the thing.
Everyone's thinking. Everyone's thinking that at the moment. Like, I'll buy back in later, cheaper.
Well, I mean, I don't dislike this company. I think it's a high margin business, but it's just, I don't know. It needs to prove itself out a bit more now. Saying that, maybe next week they announce that they've got this $1 billion contract that goes to the moon. But I'm just, I just pull. I don't need to have this kind of exposure. I don't think.
Well, you're not buying a dream. That's what I'm trying to learn. Not buying dreams anymore. And I think the market's slowly realizing that as well. They don't want to be buying dreams. They want to be buying cash flows.
Yeah.
Hopefully.
And I think that's, we still haven't got that through here in Australia about a lot of these sort of small SaaS businesses that have these they're a long duration asset.
Yep.
This which basically means they don't make any money for a long time, and people are starting to say, yeah, we kind of need you to though. If you look at a lot of their share prices reflects that. Anyway, I just thought I'd throw that in there. Keep you updated on what I'm doing.
Yep.
Losing. Actually, so I bought that stock at 20 cents. I sold it for 20.5. So I got out relatively unscathed. A huge 2.5% profit. Take out the brokerage fees. Basically, just swap some money out. Basically, yeah.
Oh. You did the mature thing there, and probably in past you would have just held on. And I think it's the mature thing, thinking I don't see it, and
it's not terrible. The business is growing. There's no doubt about that. It's just I don't need to be there. It's just too much risk for me at the moment. And you're right. I probably would have normally held on. But yeah, this is probably one of the shortest holding periods of any stock I've ever had. I think I would be hard pressed to find another one. I think I held it for about 3 weeks. Yeah. Alrighty. So you've just taken a look at Australia this week. It's a bit of a change for you. What are you looking at here? Smartgroup.
Yeah, well, US dollar is just, so expensive. And we looked at UK, that's on parity with Australia, pretty much the same. But I thought, look closer to home. I like Technology One, which is another one of these SaaS companies. But it's got a price to free cash flow of about 60. So it's a little bit rich for me.
Yeah.
And it still hasn't come down. So, I'm trying to look elsewhere. What could I spend, some AUD on?
Yep.
And I come across this one, Smartgroup. And so basically they just tax, government departments, which are going to be pretty resilient in a recession. So they just outsource services like payroll services, but mainly salary packaging. So that's like fleet management, salary sacrificing, all that stuff. So there's a lot of room for government departments to outsource that to a professional instead of trying to do that all in-house. And so you've got multiple layers of government in Australia. Even some corporates may take this on. If you're a medium-sized company.
Yep.
You may think, oh, should we hire someone to do this, understand all this? It'd be a huge burden on the company. So I think it has got room to grow. As you can see, the return on invested capital is starting to increase now in the low 20s. Look at the price to free cash flow is insane. It's under 10. So it's obviously extremely cheap. But
as the share price got smacked around, has it?
Yeah, like it's got whacked a little bit.
Yep.
They had lost a government contract, some education department.
Yep.
So as soon as you start doing things like that, and you got the CEO coming on saying, we're going to make it up the pipeline, blah, blah, blah. But, I just like these asset light companies that I can see that they've got plenty of room for growth. And it's not going to cost them much to add on another few government departments, So the only problems is just they're like all Australian companies, they just pay out such a high payout ratio. So nothing gets reinvested in the business. So you got like these 60 to 90% payout ratios. And so you look at this return on invested capital, return on equity, and not much is actually going back into the business. And you think something like this, you think they should be grabbing onto a few more areas of the market, and I can't see.
What are they doing if they're not?
Yeah, well, they're paying it out to shareholders, which is insane. I think, but that's what they do, and Australians, they seem to love that. So I don't know, just one of those things. I think it's going to go well. It's just, a little bit more pain to come with interest rates. Some of these things that are going on. So I think, one of these ones that I'm added to the watch list. Don't know if you got any comments about it, or you heard about it?
No, I never heard of it. It's this funny thing in Australia is we don't really have many decent technology businesses. It's just, when you compare them to the kinds of returns and the kind of cash flow generation of sort of American ones, it's slim pickings in Australia. Like WiseTech is one that people love at the moment, but it's got a PE of 90 or something like that. It's absurd. Free cash flow multiples like 50 or something. It's just crazy valuations. So I think because we've got relatively few, the ones that we do have that are any good are just, priced ridiculously. Look at Xero. I mean, I understand the Xero story, but I mean, I just can't get my head around how the valuation on that thing is so much built into it.
And you've got to like Zip Pay and Afterpay. Everyone's, been burnt on that sort of thing. So
Afterpay, to be honest, I mean, didn't they time it beautifully to get bought out? Because I would think that their stock would be down 80% if they were still listed. Right? They just got bought out at the top of the cycle. Perfect timing. And everyone can say they were geniuses because they picked Afterpay when, that'll all come undone, I'm sure.
So that's so this another one, sort of a little bit more conservative. So
I know this one.
Yeah, this is like Mine Lab. I don't know if you know what gold detecting is. It's basically they got these wands they put out of the ground, and you're not going to be spending like hundreds or thousands of hours out doing this hobby or semi-professionally if you haven't got the best equipment, because you miss something, it's going to cost you hundreds of dollars. So you're more likely to spend big to make sure you're getting everything you can for the time you're spending. But it's also got another communications arm that does radios and stuff for the military. So, I don't think that's going to get outsourced to China anytime soon, for obvious reasons. It's sort of like Motorola in the US, like it's a pretty solid company because, all the government contracts are sort of police and military are sort of linked together. Again, you can look at the price of free cash flows, pretty low, but you can see it's got a 5 there in the past, 2017 or something. So it could halve from here. But, return on invested capital is still in the 20s, mid-20s.
Yeah. Return on equity is good. Yep.
Yeah, so nothing to
there
really...
must be decent allocators. these
Yeah,
guys.
yeah. But like free cash flow is halved.
Yep.
Over like a lot of things since the pandemic.
Yep.
And again, the payout ratio is just insane. So they're not actually, even though that return on invested capital number's high, they're not actually putting much back into the business.
So is this correlated then with the mining commodity cycle then, is it? I mean, if you get, so you would expect that this, if we're going into a slowdown and commodities are coming off and all of that, then this could be in for a bit of pain, but at some point you get on the backside of that, whenever it is. Yeah.
Yeah, the gold price. So like you're not going to get amateurs going out, detecting for gold if the gold price just keeps going down.
Yeah.
So because it's harder and harder to find, the price going down, you're not likely to spend the hours on it. It's not going to be a fun hobby if you.
But what is this metal? Is this not someone with a metal detector going along a beach, that kind of thing? Is it, or is
Yeah,
it?
yeah, it is.
It
But
is.
it's more out in middle of nowhere. That's where you
Right.
make.
But so typically mining companies take assays. They drill cores into the. So that's not what we're talking about here, is it? Is it
No.
or not? No.
So, but a lot of mining companies actually pay amateurs to find alluvial, like surface gold, and then that gives them an idea where it's come from the reefs and where they actually can mine from there.
Right.
So it's got a bit of a link to the actual proper mining industry, but it's more on the low end. Like you spend $5,000 and that's your investment, and you can find enough gold to keep you going, like as a sort of a side hobby, on the side. But obviously they export these things all around the world because we're a world leader. It's sort of like cochlear, cochlear implants,
Yep.
The only other product that we actually make in Australia that actually gets exported, like besides sticking holes in the ground. So this is sort of similar to that, but it's just hated at the moment. And you're right, it's going to get even like the hate is going to come on here super hard as gold collapses even more. But at some point, this is going to look so terrible, it's going to be great.
So you're saying if the gold price gets to bid, then these guys will, okay.
And you got the protection of the communications defense side of it, just sort of give you a little bit of margin of safety there, even though the places look like it's burned into the ground. So that's what I sort of like about it.
Yep. Okay. Well, that's an interesting one. Good to see you looking in our own backyard, but slim pickings as usual in Australia.
Yeah,
isn't it? Yeah. Was that all we had this week?
Yep.
Was that the last one? That's all we had. All right, not bad. We're getting these down pretty quick now. So I bet you our viewers, all three of them, are excited that they can listen to us for under 40 minutes now. It's wonderful. All right. Well, that's the case. We'll sign off and we will talk to you next time. We have been the Salty Investors.